There's a difference between falling and crashing. Right now, the global economy isn't standing on solid ground. It's falling through the air. And because nothing has hit the ground yet, everyone assumes everything is fine. But gravity doesn't care what you believe. In 1929, it took 55 days from peak to panic. In 2008, it took 18 months. We entered stage 4 inches, 2023. Stage 5 is the impact. And when you understand the pattern, you'll see we've been falling the entire time. What you're about to learn isn't speculation. It's pattern recognition across 96 years of documented collapses. 3 economic earthquakes, 1,000, 929, 2000, 2008. Different headlines, same blueprint. 5 stages, repeated with mathematical precision. And every single warning sign that preceded those 3 collapses is flashing red right now in 2025. This is the story of how collapses aren't random, they're sequential. They follow a pattern so reliable that once you see it, you'll understand why the next crash isn't a question of if, but when, and why we're closer than anyone in power wants to admit. Welcome to Financial Detective, where we don't predict the future, we reveal the pattern. September 5th, 1,929. The Dow Jones Industrial Average hit an all-time high of 381 points. Stocks had tripled in 3 years. Everyone was rich on paper. Margin debt, borrowing money to buy stocks, had exploded to $8.5 billion, equivalent to 10% of the entire US GDP. Factory workers were day trading. Shoeshine boys were giving stock tips. The president said prosperity was permanent. That same day, Roger Babson, a statistician and economist, stood before the National Business Conference in Massachusetts and said this: "Sooner or later, a crash is coming, and it may be terrific." The audience laughed. The newspapers mocked him. The Wall Street Journal called him a prophet of doom. Investors ignored him completely. And then, 55 days later, on October 24th, 1,929, Black Thursday arrived. The market lost 11% in a single day. By November, the Dow had fallen 40%. By 1932, it had lost 89% of its value. $30 billion in market value vaporized. That's $500 billion in today's money. 9,000 banks failed. Unemployment hit 25%. The Great Depression had begun. Babson wasn't psychic. He was reading data. He was tracking the pattern, and the pattern was screaming. Margin debt had reached unsustainable levels. Credit had expanded faster than production. Stock prices had detached from earnings. And most critically, insiders, the people who actually ran the companies, were selling while the public was buying. The pattern exists. It's been documented. It repeats, and it's not complicated. It's 5 stages, mathematical, predictable, and we're deep inside it right now. Every collapse begins the same way, not with a crash, but with a party. An explosion of borrowed money flooding into the system, credit growing faster than the economy itself. This is stage 1, the foundation cracking beneath the celebration. In 1929, margin debt reached $8.5 billion. You could buy $100 worth of stock with just $10 of your own money. The rest was borrowed. Banks were handing out loans to anyone who asked. If the stock went up 10%, you doubled your money. But if it fell 10%, you lost everything and owed the bank. The entire market was built on leverage. One push and the whole structure would collapse. In 2000, it was different packaging, same mechanism. Instead of margin loans, it was venture capital flooding into dot-com companies with no revenue. Pets.com raised $82.5 million and spent it on a Super Bowl ad. The company had never made a profit. It went bankrupt 9 months later. But before it died, its stock had traded at $14 per share. That's pure credit-fueled delusion. In 2008, subprime mortgages, banks lending money to people who couldn't repay. then packaging those loans into securities and selling them as AAA-rated safe investments. By 2007, subprime mortgage debt had reached $1.3 trillion. Lehman Brothers was leveraged 30 to 1. For every dollar they owned, they owed 30. One bad bet, and they'd collapse. Which they did. Now let's talk about 2025. Total U.S. debt. Government, corporate, household stands at $100 trillion. That's 350% of GDP. Corporate debt alone is $13 trillion, the highest in history. Credit card debt just hit $1.13 trillion, an all-time record. And here's the part nobody talks about: shadow banking. Non-bank financial institutions, hedge funds, private equity, holding $63 trillion in assets globally. They operate with zero regulation, maximum leverage, and when they collapse, they take the system with them. This is stage one, the credit explosion, the borrowed money that creates the illusion of wealth. And just like 1929, just like 2008, it's not sustainable. It never is. Stage two is where the illusion becomes obvious, but only if you're paying attention. The market looks healthy, indexes are rising, headlines say everything is fine. But underneath, the market isn't broad, it's narrow, dangerously narrow. A handful of stocks are holding up the entire structure. This is the concentration trap. In 1929, one stock dominated: RCA, Radio Corporation of America. It was the Tesla of its era, the future. The stock rose 500% in 2 years. Everyone owned it. And RCA alone was responsible for a massive portion of the market's gains. When RCA collapsed, it took the market with it because there was nothing else holding it up. In 2000, it was the dot-coms. At the peak, technology stocks made up 35% of the S&P 500's market cap. 5 companies, Microsoft, Cisco, Intel, Oracle, and IBM, accounted for most of the index's gains. When the bubble popped, the Nasdaq lost 78%. The S&P 500 fell 49%, and it took 7 years to recover. In 2008, the concentration was different, but just as dangerous: financials. Banks and investment firms made up a disproportionate share of market value. When Lehman Brothers failed, it triggered a cascade. Bear Stearns, gone. Merrill Lynch, gone. AIG, bailed out. The whole sector collapsed. And because it was so concentrated, the entire market followed. Now, 2025, the Magnificent Seven: Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla. These 7 companies represent over 30% of the S&P 500's total market capitalization. Nvidia alone has added more market value in the last 2 years than the entire German stock market. If these 7 stocks fall, there is no market. The rest of the S&P is flat or declining, the breadth is collapsing, fewer and fewer stocks are participating in the rally. This is textbook stage 2. And here's the critical data point. In January 2025, just 27% of S&P 500 stocks were trading above their 200-day moving average. That means 73% of the market is already in decline. But the index keeps rising because 7 stocks are carrying it. That's not a healthy market. That's a market on life support, waiting for the plug to be pulled. Stage 3 is the silence before the storm. The public is still buying. CNBC is still bullish. Reddit forums are still posting gain screenshots. But behind the scenes, the people who actually know what's happening are quietly heading for the exits. This is the smart money exit, and it's happening right now. In 1929, Joseph Kennedy, John F. Kennedy's father, famously sold all his stocks in early September. Why? Because his shoeshine boy had given him a stock tip. Kennedy realized that when shoeshine boys are speculating, the market has run out of buyers. He exited at the top. 2 months later, the crash wiped out everyone who stayed. JP Morgan did the same. Quietly liquidated positions, moved to cash and gold. The insiders knew. They always know. because they have access to data the public doesn't see. They see the credit drying up, they see the leverage becoming unsustainable, and they leave before the collapse. In 2008, the pattern repeated. Goldman Sachs executives were selling mortgage-backed securities to their own clients, while simultaneously shorting those same securities. They knew the mortgages were toxic. They knew the system was collapsing. And they profited from both sides. By the time Lehman fell, the smart money was already out. Now look at 2025. Insider selling has reached record levels. Mark Zuckerberg sold $1.3 billion in Meta stock in Q4 2024. Jeff Bezos sold $8.5 billion in Amazon shares in early 2024. Nvidia insiders sold $700 million in stock in the last 6 months. These aren't small portfolio adjustments. These are mass exits. And it's not just tech. CEOs across every sector are selling at the fastest pace in over a decade. Corporate buybacks, which prop up stock prices by reducing share count, have slowed dramatically. Meanwhile, retail investors, everyday people, are buying at record levels. Robinhood reported its highest ever daily active users in December 2024. This is the exact pattern. The smart money sells, the public buys, and when the collapse comes, the public holds the bag. Stage 4 is where we are right now, and it's the most dangerous stage because everything still looks fine. Markets are near all-time highs, unemployment is low, GDP is growing, but the oxygen is gone. The liquidity, the cash flow that keeps the system alive, has been cut off. This is the liquidity illusion. The economy appears stable, but it's suffocating. In 1929, the illusion lasted until it didn't. The Federal Reserve had tightened credit in 1928 to cool speculation, interest rates rose, borrowing became expensive, but stocks kept rising anyway because momentum and euphoria overrode logic. Then, in October, liquidity vanished. Nobody could borrow, nobody could sell. The market froze and collapsed. In 2008, the illusion was housing. Prices kept rising even as subprime defaults were accelerating. Lehman Brothers reported profits in Q2 2008 while simultaneously hemorrhaging cash. The liquidity dried up in the shadow banking system first. Money market funds, commercial paper, overnight lending, all seized. And when liquidity disappeared, the entire financial system collapsed in 48 hours. Now, 2025. The Federal Reserve raised interest rates from 0% in 2022 to 5.5% in 2023. The fastest rate hike cycle in 40 years. They also began quantitative tightening, pulling $95 billion per month out of the financial system. Since 2022, the Fed's balance sheet has shrunk by over $1.5 trillion. That's $1.5 trillion in liquidity removed from markets. And the cracks are showing. In March 2023, Silicon Valley Bank collapsed, the 16th largest bank in America, gone in 48 hours. Why? Because rising interest rates destroyed the value of their bond holdings, and when depositors panicked, there was no liquidity to cover withdrawals. First Republic Bank failed next. Then Signature Bank. 3 banks, over $500 billion in assets, vaporized. But the real warning is what's happening in commercial real estate. Office buildings are empty. Remote work killed demand, and those buildings were financed with cheap debt. Now that debt is maturing, and it has to be refinanced at 7% interest rates instead of 2%. The buildings can't generate enough rent to cover the new payments. Defaults are accelerating. $1.5 trillion in commercial real estate loans are coming due between 2024 and 2026. The regional banks that hold those loans are in trouble, and nobody's talking about it. This is stage 4, the liquidity illusion. The economy looks stable, but the foundation is collapsing. And when the illusion breaks, stage 5 begins instantly. Stage 5 is the impact. The moment when the falling stops and the crashing begins. And here's what you need to understand. The trigger is never the cause. The trigger is just the spark that ignites a structure already soaked in gasoline. The system was going to collapse anyway. The trigger just determines when. In 1929, the trigger was the Hatry case. Clarence Hatry, a British financier, was arrested for fraud in September. His companies collapsed, and the panic spread to New York. British investors started selling US stocks to cover losses. That selling triggered margin calls. Those margin calls forced more selling, and within weeks, the entire market was in free fall. Hatry didn't cause the Great Depression. He just lit the match. In 2008, the trigger was Lehman Brothers. On September 15th, Lehman filed for bankruptcy. $639 billion in assets. Gone. But Lehman didn't cause the financial crisis. Subprime mortgages, over-leveraged banks, and fraudulent securities caused it. Lehman was just the domino that fell first. So what's the trigger in 2025? Nobody knows. And that's the point. It could be anything. A Chinese invasion of Taiwan that cuts off semiconductor supply chains. A commercial real estate collapse that takes down regional banks. A sovereign debt crisis in Japan, where government debt is 264% of GDP. A derivatives meltdown in the shadow banking system, or something nobody's even talking about yet. The trigger doesn't matter. What matters is that the system is fragile, over-leveraged, illiquid, and waiting. When the trigger comes, it won't be the cause, it'll be the excuse. The headline everyone points to while ignoring the 5 stages that made collapse inevitable. Here's what makes stage 4 so dangerous. Everyone can see the warning signs, but nobody wants to believe them. This is the architecture of denial, the psychological trap that keeps people invested until it's too late. And it's engineered into the system deliberately. In 1929, even after the market peaked in September, economists and politicians insisted everything was fine. President Herbert Hoover said, "The fundamental business of the country is on a sound and prosperous basis." That was October 25th, one day after Black Thursday. Treasury Secretary Andrew Mellon told investors to buy stocks because they were cheap. The crash accelerated. Why do they lie? Because the system depends on confidence. The moment people lose faith, the moment they start pulling money out, the collapse becomes self-fulfilling. So those in power have no choice but to deny reality until reality denies them. In 2008, the denial was systematic. In March 2008, Bear Stearns collapsed. Ben Bernanke, chairman of the Federal Reserve, said the subprime crisis was contained and wouldn't spread to the broader economy. In July 2008, 2 months before Lehman failed, Bernanke testified to Congress that Fannie Mae and Freddie Mac were adequately capitalized. They weren't. They were nationalized 6 weeks later. And it wasn't just incompetence, it was incentive structure. If Bernanke had told the truth, if he'd said, the financial system is collapsing and we can't stop it, there would have been an immediate bank run. Every depositor would have pulled their money. Every pension fund would have liquidated. The system would have collapsed instantly. So he lied. Not because he was evil, because the system requires lies to function. Now, 2025. Jerome Powell, current Fed chairman, insists inflation is under control and the economy is achieving a soft landing. No recession, just a gentle slowdown. Treasury Secretary Janet Yellen says the banking system is sound and resilient, despite 3 major bank failures in 2023. And CNBC analysts tell retail investors to buy the dip every time the market pulls back 2%. But the data tells a different story. The yield curve, the difference between short-term and long-term interest rates, inverted in 2022 and stayed inverted for over a year. Every single recession in the last 50 years was preceded by a yield curve inversion. Every single one. The curve is now uninverting, which historically happens 6 to 12 months before the recession actually begins. That means we're in the window right now. Credit card delinquencies are rising. Auto loan defaults are accelerating. Commercial real estate vacancies are at record highs. Corporate bankruptcies in 2024 were up 40% year over year. In the labor market, the last pillar of strength is starting to crack. Layoffs in tech, finance, and retail are accelerating. Job openings are falling. The unemployment rate is ticking up. But nobody in power will admit we're in stage 4. They can't. Because admitting it would trigger stage 5 instantly. So they do what every government does before a collapse. They deny, delay, and hope something changes. It never does. The 5-stage collapse pattern isn't just historical observation. It's mathematical inevitability. And once you understand the math, you'll see why no government, no central bank, no policy can stop it. Here's the equation. Economic growth is based on productivity, the ability to produce more goods and services with the same resources. But credit growth, borrowing, can expand faster than productivity. And when credit expands faster than production, you get asset bubbles, stocks, real estate, bonds, all inflated beyond their real value. In stage 1, credit expands. Asset prices rise. Everyone feels rich, but the wealth is fake. It's not based on production. It's based on borrowed money. And borrowed money has to be repaid with interest. In stage 2, the credit starts concentrating. Instead of spreading across the economy, it flows into a few assets, 7 stocks, a handful of real estate markets. This creates fragility. If those assets fall, the entire system falls with them. In stage 3, the people who understand the math, the insiders, start exiting. They know the credit can't sustain the asset prices forever. So they sell while prices are high and move to cash or safer assets. In stage 4, the credit stops expanding. Interest rates rise, or lending standards tighten, or both. And suddenly, the asset prices can't be sustained. But momentum keeps them elevated for a while. This is the illusion, the falling without crashing. Gravity is pulling, but impact hasn't happened yet. Stage 5 is when the math catches up. The debt can't be serviced, the assets can't be sold at inflated prices, and the system realizes all at once that the wealth was always fake. That's the crash. The moment when perception aligns with reality. And here's why it's inevitable. Debt grows exponentially. A 5% interest rate means debt doubles every 14 years. But productivity grows linearly, maybe 2 to 3% per year in a healthy economy. Eventually, the debt overwhelms the production. The math doesn't work. And when the math doesn't work, the system collapses. The U.S. national debt is $36 trillion. It was $28 trillion in 2021. That's $8 trillion added in 4 years. Meanwhile, GDP grew from $23 trillion to $27 trillion. Debt grew twice as fast as the economy. That's unsustainable. And it's accelerating. Interest payments alone are now $1.1 trillion per year. That's more than the defense budget, more than Medicare. The government is borrowing money just to pay interest on previous borrowing. That's the definition of a debt spiral. And it's not just the government. Corporations, households, everyone is overleveraged. Total U.S. debt to GDP is 350%. For every dollar of economic output, we owe $3.50. That's never been sustainable in history. Not in Rome, not in Spain, not in Britain. And it won't be sustainable now. The 5-stage pattern isn't a theory, it's math. And the math says we're in stage 4, approaching stage 5. The only variable is timing, but the outcome is deterministic. Three collapses. 1,929, 2000, 2008. 5 stages every single time. Credit explosion, concentration trap, smart money exit, liquidity illusion, trigger. The pattern doesn't change. It just repeats. And right now, in 2025, we've completed stage 4. The credit explosion happened. Total debt is at all-time highs. The concentration trap is set. 7 stocks hold up the entire market. The smart money is exiting, insiders are selling at record levels, and the liquidity illusion is cracking. The Fed pulled $1.5 trillion out of the system, and the cracks are visible. Stage 5 is the impact, and when it comes, it won't be slow, it'll be sudden, because that's how gravity works. You can fall for a long time, but when you hit the ground, it's instantaneous. The question isn't if, the question is when, and more importantly, are you prepared? Here's the question for you. If you had to guess, What do you think the trigger will be in 2025? A Taiwan crisis? A bank collapse? Something else? Drop your answer in the comments. And if you want to understand how the system is designed to keep you blind to these patterns, how the mechanisms work, and what happens next, subscribe. Because when stage 5 begins, you'll want to know what you're watching and why. The answers aren't hiding in the future. They're written in the past. And the pattern never lies.